Welcome to today's The Mortgage Mastery class. Today we're dissecting the details between 4 different types of loan products. And this is not all, this is just some of those loan products. Get your notepads ready as we discuss USDA, FHA, conventional, and VA loans. We are simply going beyond the basics to the specifics that'll empower you to make the most informed decisions. USDA loans are perfect for accessing the American dream, specifically in more rural areas. Now, a couple of things to note about USDA loans. They are area specific. The property must be located in an area designated to be rural by the United States Department of Agriculture and the Rural Development Team. This also includes towns and populations typically of less than 20,000. The second thing on USDA loans is lenders will examine up to 24 months of income history to ensure stability and check that you don't exceed the local income limits. USDA does have specific income limit for their loans. Number 3, one thing that a lot of people don't discuss is the credit depth in which USDA loans go. Typically, if your score is under 640, you may need to demonstrate a strong credit history with typically 3 non-traditional sources like utility payments, insurance, cell phone bills, etc. The last thing on a USDA loan is rates are competitive. But just like any loan, they are subject to change daily, sometimes multiple times a day. All USDA loans are 30-year fixed-rate mortgages. USDA charges a guarantee fee and an annual fee. There is a 1% guarantee fee paid at closing that is typically rolled into your loan. And then there's an annual 0.35% fee on the remaining principal balance. That is typically added to your loan payment each month. So USDA loans provide a unique opportunity for 100% financing, so long as you meet the criteria that is set forth by the USDA Rural Development Team. Our next product is FHA loans. FHA loans are known for their accessibility. Sometimes people even say that FHA loans are bridging the credit gap. Let me give you a couple of details on FHA loans to pay attention to. Number 1, mortgage insurance premium details. So FHA, like USDA, does charge an upfront mortgage insurance premium, and that is 1.75% of the loan amount. And they charge a monthly mortgage insurance premium, which varies based on loan terms, loan amount, and LTV. The second thing is credit score. While 580 is the standard for the 3.5% down payment, those with scores between 500 and 579 must have a 10% down payment and typically do face stricter underwriting because of the riskiness of the loan. Number 3, property and repair escrows. The home must be FHA approved, and any required repairs identified by the appraiser may need to be completed before closing or financed into a repair escrow. Please be sure to check with your lending professional about repair escrows. Number 4, loan limits. These are geographically dependent. Typically, that means higher limits in more expensive areas. For 2023, the standard FHA loan limit for low-cost areas in and around Alabama is $420,680 for single-family homes. Next, the broad discussion of products is conventional loans. This is typically what people are talking about when they say just a 30-year fixed-rate loan. Conventional loans offer a diverse landscape. Conventional loans are also offered as a broad spectrum of options. Let me give you a couple of details regarding things to pay attention to on conventional loans. Number 1, PMI details. Private mortgage insurance, which we discussed in FHA and USDA, all carry the PMI details. PMI can vary from lender to lender and is based on down payment and credit score. What a lot of banks won't tell you is it can be canceled once you reach 20% equity. So in easy math, if you got a $100,000 home and your loan to value or your balance of your loan is less than $80,000, you can typically request that PMI be removed. Now there are some time limits on that, so please check with your lending professional. Number 2, loan to value ratios. For the best interest rates, you need to aim for an LTV of 80% or lower, though loans with up to 97% loan-to-value are available for qualified borrowers. One thing that trips people up in underwriting a lot of the time is self-employment requirements. Self-employed borrowers need 2 years of tax returns and will undergo a more rigorous income verification process. Number 4. Conforming versus non-conforming. Conforming loans follow guidelines set by Fannie Mae and Freddie Mac, including loan limits. Non-conforming loans, or jumbos as we call them, exceed these limits, and they themselves have their own underwriting standards. Sometimes they can be more stringent because the loan amount is higher. Last but certainly not least is one of my favorite loans, and that is a VA loan, a loan that is set out for our veterans, who we consider our heroes. VA loans are a token of gratitude for military service. Never enough, but it is a token of service. A couple of items that you need to pay attention to on VA home loans are as follows. Number 1, they require a certificate of eligibility, and this certificate requires evidence of service duration and discharge conditions. Like FHA and USDA, VA charges a funding fee. This fee ranges from 2.3% to 3.6%, depending on the number of times you've used the benefit. It is often waived for service-related disabilities. All this information is shown on your certificate of eligibility. For the National Guard, there are a few requirements that you have to have on your certificate of eligibility or a point statement. Be sure to check with your local lending professional. Number 3, secondary borrowers. Non-veteran co-borrowers are permitted, but this may require a down payment and can certainly change the terms of the loan. Number 4, the VA appraisal. Now, just like every other loan, it's an appraisal on the property to make sure that the home is worth what it is being sold for. VA appraisals are commonly known as the Certificate of Reasonable Value. This appraisal ensures the property value meets the loan amount and addresses any safety concerns. And that last point, any safety concerns, is a big one because VA is very stringent on anything that may be a hazardous risk, including handrails, gaps in spindles on a deck, etc. Now, the last thing I want to slightly touch on, other than USDA, FHA, VA, and conventional, are portfolio products. And as things have changed in the mortgage industry and real estate industry, these have become more and more prevalent. Portfolio products, to me, have an expansion to beyond standard guidelines. Portfolio products are often considered alternative paths. So what kind of portfolio paths can we have? Here are just a few. Asset-based loans. For borrowers with significant assets but irregular income, these loans use liquid assets to qualify for the loan instead of traditional income. Number 2, interest only. These type loans allow for lower monthly payments initially by paying only the interest, with the principal due later in the loan term. Number 3, one of my favorites, especially for self-employed borrowers, are bank statement loans. Bank statement loans for self-employed individuals use 12 to 24 months of bank statements to verify income instead of the traditional tax document. So in closing, there are many different loan products, and I've only scratched the surface. A detailed guide through the landscape of mortgage loans. Remember, in this industry, knowledge is power and leadership is key. There is a lot of misinformation out there. If you're looking to learn, grow, and lead in the mortgage industry, I'm here to help pave that way. Reach out, subscribe. Let's create wealth through wise lending practices.